Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Thursday. It's December 14th. Christmas is almost here. Where is this year going? I'm still living in February of 2023. It's about 7:34 in the morning. The market's not going to gear up to open up for about an hour and 56 minutes if my math serves me correctly. I think it does. The Nasdaq is up pretty good this morning. The Dow's up beyond average, but boy, oh boy, this Nasdaq is sharp. As everyone knows, we had the FOMC yesterday. Big report from the Fed. They're keeping rates steady as we assumed, but the trajectory of their interest rates have become better. In other words, they're now looking to, at least the bond market is pricing in the fact that the Fed is going to start lowering even earlier than expected. Now, the odds of a March cut is priced in at over 70%, and I'll talk about that in a minute. Now, interestingly, almost every question that Powell was asked, I usually don't listen to them. I usually just read afterwards what happens. But in this case, I was driving back. I got a haircut yesterday, so I was driving back, and I was listening to Bloomberg. And I was listening very carefully to the speech, and I was very carefully listening to the comments. And obviously, almost every comment, I think 9 out of 10 comments were regarding, so are you changing your plans for the future? Are you going to start lowering in March? And he had a pre-canned answer. The answer was, we're going to start discussing that next. But he never wavered from the fact that we still have to wait and see. We are still in a challenging environment. Our job is not done yet. We may still have to raise rates. Basically, he still sounded like they're climbing that uphill instead of going down that hill. And honestly, here's the thing, and this is the lesson here. Regardless of what I think, regardless of what Powell says, you have to trade what the market gives you. The market has been giving us really bullish. My analysis was that the bond market was going to crap out and start going down, and that may cause the stock market to cool off. But I didn't trade that way. In other words, and I don't think I've had a short position on in 2 weeks. The point being is, you can't let your personal opinion. And I still think we're not going to have rates in March going down. I still believe that. And I'll talk about that more. But the bottom line is, it doesn't matter what I think. It makes no difference what I think. I've been going long nonstop. I went long last night. I was holding Apple long. I was holding Discovery long. We made money on both. But the point is that you can't let your opinion dictate or reflect what you're seeing in the market. If we're making new highs, I'm going to be going long. So again, be very, very mindful of what I'm talking about. Separate your analysis from the technicals and what price action is giving you. If you can't do that, it's going to be a problem. So right now, the bond market, and this is the bond market, it's sitting at the 200-day moving average. Now, we could go higher, but even 0.75 is basically priced in and baked into this market. The market is always looking for the next catalyst ahead. I don't think the bullishness, listen carefully to what I'm saying, this is important. I don't think the bullishness, the optimism surrounding the Fed lowering rates in March is going to get much higher than it was yesterday. I mean, they turned the tables on us. Everyone, all the reporters, everybody was in shock. That's why the bond market went up over two basis points. But the question is, what's next? That's priced in. Now, if that doesn't happen, watch out below. I'm not going to get into that discussion. But what is the next major catalyst? What is going to drive the market next? Look at the indexes. Look at the Russell 2000. Look at the S&P 500. Look at the financials. Look at QQQ. Look at utilities. Remember, if interest rates go down, this is great for utilities. Probably a good time to buy utilities right now. A good time to buy real estate. Good time to buy consumer staples. Most interest rate sensitive stocks went up. Most stocks went up. It was a huge day for the market. But the point is, we always have to ask ourselves, what's the next major catalyst? And now, here's the problem. With all of this positive data being baked into the market, what is the market going to discount next? Earnings are not that great. We still have negative revisions. It's a trouble right now. So we have to be very, very mindful as we head into the year and as we head to these two levels. Now, we're currently at 472.21. I drew this level yesterday to show you how accurate it is, okay? But you could see right here, this is the previous swing high. If we break this level, guess what the next level is, folks? I want to show you this. It's the all-time high. That's right, all-time high. So we're getting there. We're getting there. Now, here's the problem. Let me show you Cathie Woods. And I've been talking about this for several years now. I drew these lines right here back in middle of 2022. Now we're at the end of 2024. It's almost, and yes, I did draw these lines. You can literally go to this date on my videos, and you can find me doing it in my VIP room. And I told folks, nothing is good's going to happen until we start breaking out of these levels. Well, guess what? We're almost at those levels right now. Right there. So if we break out a little more, that will be an official reset to the bear market that we've had. Because remember, smaller stocks started going into the crapper a lot earlier, and they started basing a lot sooner. So if this breaks out, we may have a nice, juicy breakout. So keep your eye on ARK funds, and I'll talk about that in my VIP room as well. So today you've got jobless claims, retail sale. Jobless claims is going to be a nothing burger. He even said yesterday wage pressure is not a factor, and we haven't had it. So 220,000. It's been near this number now for like a year and a half. It went up to about 275, and then it came right back down. We've got retail sales, but honestly, truthfully, after yesterday's report, do you think it's going to matter? I mean, think about the sentiment in this market. Mamma mia. And then tomorrow you've got industrial production, which is a big report. And I think by that time, the market's going to start consolidating. Now, technically speaking, and I just want to show you, technically speaking, usually, not always, there's no hard and fast rule. But typically, after the market makes a move like this, it likes to consolidate. Let me show you here. It makes a move, and then it sort of goes up, but it consolidates. Makes another move, consolidates. The market doesn't move straight up. It moves up and then sideways, up and then sideways, up and that sideways. If you go back, you could see even here, up, sideways, and then back down. But you could tell markets don't move parabolically. Look, it moved up and then it moved sideways. Even though the slant is towards the upside, it's moving sideways here. And almost every pullback is bought, which is fantastic. But my point is, you shouldn't be surprised in the next couple of days, even if the market's going to continue and head towards the all-time high, which I think it will, because there's so many shorts covering right now. I think what will happen is, I think we'll hit the all-time high. Now, another thing I want to explain to you, and I'll talk about it more in the VIP room today, which is happening at 11 a.m. By the way, the link to the VIP room is below this video. If you don't know where to find this video, go to my YouTube channel. Go to YouTube, go to Roger-Scott in the chat, in the search, not chat, and you will find it, and you'll be able to post comments. Below the video in the YouTube, you will find a link to my VIP room, a link to my Telegram channel, which you really need to sign up to, and I want you to get in there ASAP. Now, we're right here. We're at 472, and I guess the next trajectory is 480. Keep your eye on that. And again, we're going to talk more about the trajectory for fund managers and more into their thinking, but they're playing catch-up right now. They're playing catch-up. They have to outperform the market. So right now, they're all, we need to buy, because they didn't expect this. And I didn't expect it either. I'll be very honest with you. Too much, too fast, in my opinion. Again, it doesn't matter, though. We trade the trend. Now, let's talk about the global market. Let's put everything together for you guys. So, and this will help you kind of put together everything I've been talking about. Federal Reserve indicated interest rate cuts next year boosted sentiment. A little too much if you ask me, but it doesn't matter. We're going with the trend. Retail sales data is going to come out today. I don't think that's going to be as big of a deal after yesterday's event. I mean, you've got a train going at you 100 miles per hour. It takes a little energy to stop it. Federal Reserve federal rate target range is going to be unchanged. They're suggesting Federal Reserve underscored three quarter-point rate cuts next year. I think that would be freaking amazing if that happened, but I'm just not seeing it yet. Jerome underscored the projections do not constitute a predetermined plan, emphasizing that policymakers are not ruling out additional interest rate increases. Here they're talking about what's priced in, 3 cuts. Meanwhile, he's talking about interest rate increases. Do you see what I mean? Do you see the disconnect here? That's what gets me. The disconnect is just so huge to curb resurging inflation pressures. But he acknowledged that officials discussed. Actually, what I heard was they're going to discuss. They're prepared to discuss. Not that they've discussed, but semantics. The question of whether it would be appropriate to initiate interest rate cuts during the week's meeting. What I heard was we're now ready to discuss that. But I didn't hear them saying we've talked about it. What I've heard them say is we're not ready to discuss that, meaning don't ask me anything because we haven't talked about it yet, which actually makes perfect sense. It's a good way out. He had that answer pre-canned. He spilled that answer so fast. I was like, that was a good one. He saw that coming. Everyone saw that coming. PPI eased. It's the slowest pace of increase in 2 3/4 years. There's now a 72.3% chance of a 25% basis point rate cut at the conclusion of the meeting in March. I completely do not agree with that, but it makes absolutely no, and it will not make any difference in my trades. I'm not going to become a bear now. I'm going to go with the flow. But again, I personally think that's pie in the sky. On the earnings front, notable companies like COSTCO, Leonard Homes, J-Bill, they're slated to release. That will impact the market. Costco will have an impact on consumer staples, consumer discretionary. Leonard Homes on home builders, big time. And J-Bill circuits on technology, semiconductors. Retail sales is today. Europe is giving us a little tailwind. They were very happy about what they heard yesterday. Real estate and mining stocks are leading the overall market higher. Now, real estate stocks are very interest rate sensitive, but I'm not sure about mining stocks. I have to think about that one. Actually, well, it depends. Not gold. But anyhow, Shanghai Composite closed slightly lower as investors digested credit data indicating ongoing weakness in domestic demand. Looks like they weren't happy about U.S. coming out to almost up to all-time highs, while also waiting a slew of economic data. Real estate and liquor stocks underperformed. Don't ask. Japan closed lower, not giving us tailwind, snapping a 3-day winning streak as the yen sharp rally failed, or falling treasury yield weighted on export-oriented stocks. I bet. All right, now sectors. As I showed you, it's very hard to determine sectors, and it's very hard to see what stocks are really strong right now because everything's really strong. So we have to be extra cautious because it's like driving a car 100 miles per hour and asking, is it fast? It's hard to gauge things around you when everything is moving. And I always tell folks it's actually twice as hard for me to pick stocks when everything's going like this, because how do I truly determine what stock is strong and weak? Because everyone's buying. When markets are flat, it's much easier. When markets are slightly down, it's much easier. But when markets are up, it's a pain in the ass. But with this said, I'm not going to go try and buck the trend. I am going to tell you right now that I actually think technology is going to continue going higher, XLK, based on the data I'm hearing. And also, retail should be going higher. So the two sectors that I'm looking at would be technology and retail. If you want me to give you the option. Sorry, let me give you technology. And I'll tell you another thing. Don't buy both of them. Just buy your favorite one. They're going to be way too correlated right now. So I'll just give you technology. How about that? We want to go, say, no, it's too far. 22 days out. That's good. Implied volatility is not high right now in this sector. You can get a pretty good deal. I would go to... I would go right here, 185. But Roger, it's in the money. Why would I do that? And the spread will tighten as the market opens up. Because 185 plus 730 is 192.70. The market's trading at 191.20. It means you're paying about $1.50 premium for this option. If you go right here to the 191, to the 190, you're going to be paying about $2 for this option, $3. So you're paying 3 times as much for this option than this much option up front. Remember, intrinsic options this option has 5 points, 6 points of this in it. So take away 6 points from this price, or 6 points and 21 cents. But you get the point. Anyway, very, very excited, very important. You know what? I'll give you retail too. Why not? I'm in a good mood today. The markets are good. We're making money. We took a builder overnight last night. Retail, look at that. XRT. XRT, beautiful. Look at that. We'll go to the option. You definitely want to go in the money on these. The implied volatility is high on this one. Right here, we'll go 29 days out. Not a lot of liquidity here. You probably want to go to... You know what? Don't do this one. Just do technology. Just not a lot of options on this one right now. The markets are closed, so I don't want to give you one because it's hard to gravitate. If you still want it, send me an email, roger@rogerscott.com. All right, before I let you guys go, the week is almost done, so I hope everybody's getting ready to see Graham's top on the clock stock, the trade before Friday's close. Graham and I are going live today, again at 1 p.m. Eastern Time. He wanted me to let you know this important information. Most well-known stocks have what he calls profit dates when they're most likely to hit a payout. And when a profit date hits a particular stock, it doesn't really matter what the news is, what institutional analysts are doing, or what White House or the squirmy Jerome Powell that the Fed, don't even get me started with him. So you could target stocks for extra income on your own schedule. Click the link below and save your seat because once 1 p.m. rolls around, Graham is going to give you his top on the clock stock for free. And he'll also show you his profit dates. What one is about to hit hard. Follow the link below. Subscribe to my YouTube channel. Just go to YouTube, go to Roger-Scott. Go to my VIP room at 11 a.m. today. Bye, guys. I'll see you later. Have a great day.